Hello everyone. Sorry for the delay in this video recording. I was quite busy. I apologize. Good morning. This is the video I promised to record. The other day, yeah, we were having network issue. Don't know if the network issue is from your end or yeah, I don't know. So this is the video. This is what I was trying to explain to you. In this video, I will explain market structure, time frame difference, sponsorship candle, valid swing point, market structure too. And if there is much time, I will touch a fair value gap and momentum impulsive and corrective wave. So here is a structure. Here is a structure. This one is also a structure. So in a structure, we have three scenarios in market structure. So irrespective of the type of structure that market presented, either a range band, uptrend, downtrend, or maybe a complex corrective wave trend, so or a weak trend rather. So we have an uptrend, we have downtrend. How do we know that this is uptrend? It is when market is creating a series of higher high, higher low, a higher high, a higher low, a higher high, a higher low, a higher high, a higher low. So it is when this trend break this high, this is a previous high. It is when market pull back down, then break this high before you can call here a valid higher low. So when market break here, it will take a rest. It will pull back to the former range. This is a former range. To pull back to the former range, then move up again. It can pull back to 50% of the former range. This is the former range. It can pull back to 50% of the former range. When you measure it with Fibonacci retracement, either 50%, 70%, 80% of the former range before it will start flying up. So it is when market break this high, this high, this high, this high, this one. It's when market break this high with this impulsive move before you can call here a valid higher low. So market will then pull back after breaking this structure, pull back, then create a new low. And it is when market break this high before you can call it a valid higher low. Okay. So here will now be our new swing point high, swing point low. So higher high, higher low is also our swing point. So swing point high, swing point low, swing point high, swing low, swing high, swing low, swing high. So that's how it is. Don't be confused with the terminology. So when market is creating a series of higher high, higher low, higher high, higher low, that is when we will call that trend an uptrend. So we have a downtrend. We have a downtrend. So this is a lower low, a lower high. So when market break this low with this trend, before we now call here, before here will now be regarded as our lower high. Here will now become our lower low. So market will, after market break this low, it will therefore trend down. After market break this low with this impulsive move, to take a break, take a breath, move up, then create a new high. That is a lower high. Then trend down again to break this low. This is when market break this low before you can regard here as our valid point. That is a valid lower high. So when market is in this region, this zone, you cannot call here a lower high? No, because market can move up to test this zone before dropping. That is why we say after market break any low, before you can call that reversal point is a swing point. So when market break this low with this trend, before you will now call it a lower high. You create this low, create this high, that is a lower high, then a new low after breaking this structure with this trend, then move up, create a new high, which is a lower high, then create a new low. That is, so when market is creating a series of lower low, lower high, lower low, lower high, breaking structure to create another structure, breaking structure to create another structure to the downside, that is when we will call that a trend, a downtrend. When market is breaking structure to the upside, we call it an uptrend. So all these points that we are expecting market not to read. So when market is pulling back to the upside, so we are not expecting market to read it. So this zone that we are expecting market not to read, all these zones that we are expecting market not to, because is a downtrend. So in downtrend, market break loose. In downtrend, market break loose. So all these highs that market created in downtrend, that is our lower highs that market created on this downtrend, is our major liquidity. We call it major liquidity, MJ. We call it major liquidity, MJQ, MJ. Call it major liquidity. All these lower high, they are called major liquidity. Why all these lows, they are called major liquidity? Because when price breaks structure to the upside, as price is trending down here, we are not expecting it to take here. So market cannot take this low. Market cannot take all these lows because it is an uptrend. So we are expecting market to be reading our highs, our previous highs. Expecting market to be reading our previous highs. So all these lows in uptrend, all these lows in uptrend, it is known as our major liquidity. Why all these high that we are expecting market to read, all these swing points that we are expecting market to read, is our external liquidity. So all these lows is our external liquidity because it's in downtrend. So market take previous low. This is the previous low. Market take it. Previous low. Market take it. All these previous lows, they are known as our external liquidity. So the highs that are expecting market to read in downtrend is our major liquidity. While in uptrend, the lows that are expecting market to, in uptrend, the expecting market not to read the lows. So that will not be our major liquidity. While the highs that are expecting market to read, all these highs that are expecting market to read, is our external liquidity. Okay, so that is for that. That is for that. So we have time frame difference. Time frame difference, it means if, for instance, this trend, okay, we have a range band structure. This is a range band structure where market does not have a specific direction. So you can't call it an uptrend, you can't call it a downtrend. So this trend is not always favorable because it does not have a particular trend. This is just a horizontal trend. Call it a horizontal trend. So market react here, move up, then trend to this resistance, then break it, then move up again to break this support again. So move up again. So as price is just doing a range band market, doing sideways market. So we can call it a range band structure, a consolidation. So that the market does not have a particular direction. So this type of market is not always favorable because you will not understand the trend of the market. You might be trading against the trend. So the trend is your friend. So you don't trade against it. So these markets, you always try as much as possible to avoid it for new trader. So that is for that. That is the 3 scenarios. So in market structure. So we have time frame difference. In time frame difference, what do we mean by time frame difference is, for instance, this structure. If this structure is is H4 time frame, H4. If this structure is H4 time frame, do you know this pullback, you can actually sell it. Or this pullback, you can actually sell it on lower time frame, like 5-minute time frame. Or this pullback, you can actually sell it. So despite market is an uptrend, you know very well that market is an uptrend. But you can also say all this pullback in lower time frame. That is, if your institutional order flow is bullish. So institutional order flow means when you are trading in line with the higher time frame. So order flow means trend. If they ask you what is your order flow means trend. And institutional order flow means trading in line with higher time frame, which means if market is in uptrend in higher time frame, so you will be waiting for market to reach some specific zone before you start buying it. So which means you are trading in line with higher time frame. So you are not concerned with the pullback trading or thereabout. So you are just concerned with the higher time frame trend. So you are trading in line with higher time frame so that market will not trap you out. So that is what we know as institutional order flow, trading in line with higher time frame. So that's it. So order flow means trend. Institutional order flow means trading in line with higher time frame. So that's for that. So we have so time frame difference means if, for instance, this structure, this uptrend is daily time frame or H4 or weekly time frame, all this pullback, you can sell them. You can sell all this pullback. So if your order flow is bullish, so all the pullback you can actually sell them in lower time frame. So that is for that. So also with this one, if price is in downtrend, if here is a daily time frame or H4, so all this pullback, all this buy, all this little buy, there is not always a straight trend without a pullback. Price will always all the pullback. So long you know your zone that my price will react, will start reversing or your reversal point. So long you know it, so you can trade the retracement move. You can trade all this retracement move, You can trade them. This pullback, you can actually buy them since market is in downtrend. All this pullback, you can actually buy them. So that is if market is in downtrend, you can buy all this pullback. So yeah, if for example this structure is a H4 time frame or daily time frame, so all the pullback you can actually buy them, because you can't just wait for price to pull back. Maybe it will take up to 4 or 5 days before price will pull back to your zone of interest before you can change the trend. So you can't just wait for 5 days for those that will be trading that will be trading two market or 3 markets. So that's for that. We have a sponsorship candle. What the sponsorship candle is? A sponsorship candle is a candle that take minor structure. So it is a swing point high that take a minor structure, or is a swing point that take a minor structure. All this, you see, market was creating series of lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. So market did not come back here. Market did not come back here. The year did not touch here. So at a point, we are expecting market to come here to before dropping, but market continue the move. So market break here, break this low, and create this high. Okay. So as price is moving up, price took out this high, took out this high, took out this high. So as price is dropping, price therefore break this low. So this high that price created after price break all these minor, all these highs, after price break all these highs, the high that price created is this one. So it is when price break here before you now call here a valid swing point. Like here will not be our sponsorship candle because it's the last point of a raid. So price raid all this place before dropping. So as price raid here, raid is low. So we now say okay, here is now our sponsorship candle because it's a high that raid all the minor highs. That is for downtrend. So like this one, price create all these minor all these minor high, all these minor lows. So here therefore price therefore push down to continue the trend from this zone. So this low now become our sponsorship candle listing, sponsorship candle because here this low is a low that read the minor lows, that read the minor lows, all these minor lows in uptrend. So the low that read all the minor lows. So it is when price break this high before you now call it a valid proportion block. So here we have our proportion block. So don't ask me the function of proportion block. I'm just showing you. So it is what we'll be discussing on chart. So that you will not ask me what's proportion block, what's proportion block. So I just want to show you what we mean by proportion block. So I will show you the function. Don't worry about that. So everything I'm teaching, I will show you on chart. So we have, so this low now will now be our valid proportion block, our valid sponsorship candle, not proportion block, our valid sponsorship candle. So is a low that created after this break of all these minor lows. So here is a high that created after raid of this minor high. It will now be our sponsorship candle. So you see here, price break here, then come down again, raid here, price raid here, raid this low with this trend. Here will now become our sponsorship candle. Here will now become our sponsorship candle because it's a low that read the minor low. Here is a minor low. So it is a low that created after BMS, which is our liquidity. So don't worry about liquidity, I will teach you about liquidity. So in uptrend, this is uptrend. So, but sometimes price will take lows in uptrend and you're expecting market not to read it. So all the points that read the previous low here will not be is our sponsorship candle. Here's our sponsorship candle. So all this place is our sponsorship candle. Here's our sponsorship candle. Here is our sponsorship candle because price rate this low. Price rate here, it created this sponsorship candle. Price rate here, it created this sponsorship candle. So price rate here with this move. Here will now become our sponsorship candle. So price rate here will now become our sponsorship candle. So that's for that. So all these, the lows that read the minor low, the low that read the minor low is our sponsorship candle. That is the general term. The low that read our minor low is our sponsorship candle in uptrend. So the high that read our minor highs, the high that read our minor high in downtrend is our sponsorship candle. So that's for that. So until when price break the previous high, before you can call here a sponsorship candle. Until when price break this low, before you can call here a sponsorship candle. So that is for that. So we have a valid swing point. you have a valid swing point. So not all point that is valid. The valid swing point here now is so valid swing point here is here. Valid swing point is here. Is a valid swing point. Valid swing point. So the zone that we expect market to start retracing from to react from is our valid swing point. So not all point that is valid. So here is a valid swing point in this scenario, in this uptrend. So the zone that we expect market to react from is our valid swing point, a deep reaction. So it's our valid swing point. That is the meaning. Here, this zone, this up here is our valid swing point. This up here is our valid swing point. So here you are expecting market to push up to this zone before dropping. Here is our valid swing point. Because when price move up to this zone to drop, here is our valid swing point, valid swing point, valid swing point. The price move up here, drop. So valid swing point. Here is our valid swing point. Here because here you're expecting market to start dropping from this zone. Here will now become your valid swing point. So here is our value swing point. Here is a value swing point. So as price break this low, so price will therefore move up to this value swing point, drop. So swing point, drop. So here is not a value swing point because we are expecting market to read all these minor high. So here will now become a value swing point. So here, all this low is our value swing point. Despite market did not come here. So here is our value swing point. As price break here, so your value swing point will now be here. So here will now still here will still be enter. You see here at value swing.
And I guess I can ask